Well, we're getting close to the end here. This is the list of things that I want to cover in different segments today. So let's begin with a review of open market operations. We said that was the primary tool of monetary policy, open market operations. We said that the Fed is outside of the economy. And the Fed. And so when it said that the Fed is expanding their portfolio, and by portfolio we're talking about an investment portfolio, how does their portfolio expand? Expanding their Fed's portfolio is synonymous with an expansionary monetary policy. An expansionary monetary policy. So how does the Fed use open market operations to expand the money supply and increase economic activity? Well, it sells something, it buys something. To expand the economy, the Fed buys, which means it creates money. Of course, the Fed is the author of fiat money, speaks it into existence, and then it takes some asset, usually a financial asset, brings it out of the economy and puts it into the Fed portfolio. So expansionary monetary policy, we expand the economy by pumping money in. The Fed pumps money in by buying an asset which goes into its investment portfolio. And this portfolio keeps getting bigger and bigger and bigger and bigger as it buys more and more things. Now, what happens once that high-powered money goes into the economy? That high-powered money becomes the basis for the money multiplier in which commercial banks can multiply the amount of high-powered money based upon the money multiplier through fractional reserve lending. Now, that has been the norm. Of course, if we're in a situation where we have a high inflationary economy, the Fed would do the reverse. To pull money out of the economy, to get money to come out of the economy, the Fed sells an asset into the economy. Money comes out of some companies or firms' bank account, and when that money leaves that bank account, it goes back to the Fed, and when it goes back to the Fed, that money goes back to nothingness from which it came. So again, this is a review of open market operations. This is the primary tool of the Fed. It's the primary tool of the Fed because it's a very secret operation. It does not reveal its operations. It's buying and selling through multiple dealers. So each dealer doesn't know exactly what's going on with the other dealers. He could be buying a whole bunch through these two and selling a little through these two, and no one dealer is going to know what's going on. So again, since the Fed is an independent it's quasi-private, quasi-government. It's part government in the sense that it's created by the federal government. And the federal government appoints the managers, the head of the Fed, but its ownership is private and its affairs are private. The Fed makes profits, obviously, but the IRS, we said that the income tax was created in 1913, the same time that the Fed was created, and that I inferred that that's because the Fed's loaning money to the government, and the government spends it, and therefore the Fed has to be assured that they can get that money back with interest, and that's a function, if not the function, of the Internal Revenue Service. Again, the government does not need any income tax to run its affairs as long as it has a Fed. As long as it has a Federal Reserve, it can spend any amount of money it wants because it can borrow any amount of money that it wants. Now that creates a vicious cycle, because the more money that the Fed creates, loans to the government, spend into the economy, the more interest that there is. And then how do you pay off that interest? Because that interest is on money that keeps growing. Think of it this way. Think of it that a bunch of guys are going to go play poker or something, and none of them have very much money. So they all get grub staked by the banker, and the banker gives him $100 and him $100 and her $100 and her $100 and her, and they all play. Now, each one of them have to pay interest on this loan of $100. So at the end of the game, some people are going to lose, but they don't have any money to pay it back, but they need to, and they have to pay back interest too, so they're going to be in debt. Somebody's going to win, and they can pay back the interest. The point is, if there's only $500 in the game, and there's, say, 10% interest on all the money that's put into the game, well, where's the interest money going to come from? There's only $500 in the game. They all owe interest. Where's the money going to come from that's going to pay the interest on the money that came into the game? And the answer is, you got to borrow that. You have to borrow that as well. So this interest continues to grow and grow and grow. Now, let's go and talk about this high-powered money. This high-powered money that comes into the economy, it goes into some bank account somewhere. That high-powered money is called Fed funds. Fed funds. Or federal funds. They nickname it Fed funds. In this class, we're calling it the bank's high-powered money. And based upon the amount of high-powered money they have, that determines how much loan expansion they can make through the fractional reserve system. But sometimes they might get short, or maybe they don't have enough high-powered money to make a loan to one of their very best customers, because they're running out of high-powered money. They have to get more high-powered money into their account before they can extend a loan, or they'll be loaning more money than they're allowed based upon their required reserves. So they got to get more reserves, more high-powered money in there. So where do they get that at? Well, we said before they could go to the Fed, but you don't usually want to go to the Fed for operations, because the only time you go to the Fed is if you're desperate. And if you're desperate, you don't want to go to the Fed and say, we're desperate, and they think, well, you're not very well managed. So the other place you can get that high-powered money is usually from other banks who have excess Fed funds that they haven't been able to find anybody to place a loan at. They have more than their required reserves, and so rather than leave them sit there, they could loan those high-powered money, those Fed funds, to other commercial banks. Sometimes they loan it for a matter of hours, or sometimes overnight, because they got to get their averages up based upon their reporting requirements. So the federal funds is this market trading place in which commercial banks can loan money to one another. They don't loan bank credit. They loan federal funds. They loan high-powered money to one another. And of course, there's an interest rate for that. There's an interest rate for those Fed funds. Now, the Fed funds, the trading of this high-powered money back and forth between commercial banks, tends to track very closely the discount rate, the rate of interest on the money that banks trade to one another. Tracks very closely with the interest rate, the discount rate that the Fed charges at the discount window. Now we're going to pick up right here and talk about what happens when, for whatever reason, the market begins to contract, like there begins to be a sell-off, maybe a loss of faith, not in the banking system per se, but maybe a loss of faith in a particular market, or a loss of faith in the stock market, because the monetary system is very, very closely tied together. And if people begin to think, oh, there might be a banking crisis, or there might be some instability in the market, or some part of the market is overheated, then they might want to sell their stock, and they want to get cash out. They want to get liquid. They don't want to be in these some Wall Street investment. Now, Wall Street has brokers there, and brokers are there to match a buyer with a seller and make an exchange and charge a fee to both people. That's how they make their money. But in order to make sure that whenever anybody says, I want to sell my IBM stock, or I want to buy some IBM stock, there has to be somebody on the other end of that buy or sell, or it doesn't happen very quickly. So in order to make this function happen, there are some Wall Street firms that are account managers, and they're allowed to trade that account on their own. So they will take a trade just to make sure it goes through very quickly. And they get some perks. They get to have some inside information if they will provide this liquidity so that when people want to buy, they can buy instantly. When somebody else wants to sell, they can sell instantly. Whether anybody else has called in to have an order on the other side, and they tend to make this thing work. Well, what happens if there's this fear, maybe a lack of faith in the stability of the market, and everybody starts to call in to their stockbroker, and they have one word. They're all saying, sell. Sell my stock. Sell, sell, sell. Now, if people call their broker and say, sell my IBM stock, but there's nobody on the other end who says, I want to buy IBM stock, that's when this broker is supposed to step in and fill that trade, and hopefully they'll find somebody else sooner or later that they can trade back out of it, but they're supposed to make that particular market liquid. But if everybody wants to sell and nobody wants to buy, in theory, what is the value of that IBM stock if everybody wants to sell it, and at this 5 minutes there's nobody that wants to buy it? It can go to theoretically zero, at least for that period of time. It goes to zero because I want to sell this stuff. Any buyers? Any buyers? Any buyers? And there are no buyers. Then it starts to go down. Now we begin to have this self-fulfilling prophecy thing. If everybody begins to be pessimistic and sell, then the whole market starts going down, and everybody's selling and nobody's buying, and all of a sudden the market value of all these stocks begins to go south to zero. When that happens, sometimes they'll actually shut down the market, saying, nope, we shut down the market, there's no buying and no selling, especially no selling, right? Until we can restore market confidence, until we can do something here to restore the confidence that these stocks are really good, the stock market's really sound, our entire financial system is sound. One of the things in 2008, which was one of those times when everything was going south and everybody wanted to sell and nobody wanted to buy, one of the things that Alan Greenspan, who was chairman of the Federal Reserve at the time, had up his sleeve was called the Plunge Protection Team. The Plunge Protection Team. Now, the Plunge Protection Team we have these stocks, and they're going down, plunging down. And they're going to continue to go down until somebody begins to buy, which supports the price. But if nobody's supporting the price, everybody wants out and nobody wants in, then the Fed goes to these Wall Street brokers, which have responsibility for making a particular stock liquid, saying, we got to break this psychology. Tell you what we're going to do. We are going to loan you money to buy this stock. We're going to loan this money to. Well, why in the world would they take that loan? Well, they got to come up with the money somewhere. We got to stop this downward plunge. And if the Fed, not just the banker of last resort, but Wall Street's buyer of last resort, says, okay, here's what's going to happen. We're not going to run out of money, and we will continue to loan you money until this stock begins to go back up, and once we break the customer pessimism, the market pessimism, the stock will go back up. So all you have to do is keep buying, keep buying, keep buying all the way down. And why in the world would you ever borrow money to do that? Because we're going to keep giving you money until it starts going back up again. And once it goes back up again, you bought low, and you're going to start selling high. How do you make money in the market? You buy at a low price, and you sell at a high price. And if you've got the Fed's money behind you to buy this stock, and they're not going to run out of money to buy this stock, then that's a pretty good bet of making money. Yeah, we'll borrow money to buy the stock that's plunging, if you guarantee me that you're going to keep buying until you drive the price back up to restore customer confidence, and then when the stocks get back up here, we can take this stuff that we bought very low on the Fed's borrowed money, and then we're going to turn around and sell it when the price goes back up for a nice, tidy profit. So the number one rule for investors is do not fight the Fed. If the Fed says something's not going down, they're going to spend whatever money it takes to make their prophecy come true. And that's why we have a whole army of financial journalists out there that their entire job is to watch the Fed. Watch the Fed. What's the Fed doing? What are they signaling? Now, Alan Greenspan and every other chairman of the Federal Reserve signals to the market saying the market is overheated, we're going to bring inflation down. Okay. Or we're in the doldrums, we're in a recession here, and we're going to drive asset prices back up. So whichever they're going to do, if you know what the Fed has planned and saying, this is our target and this is what we're going to do, you don't want to get on the other side. You don't want to bet against the Fed. There was a rule, it doesn't really apply very much, but at least in Wall Street there was this common maxim, 2 bounces and a kick. In other words, if one of the ways that we can expand the economy is to reduce the discount rate, reduce the Fed funds rate, reduce the cost of borrowing money. And so the Federal Reserve Chairman would lower the discount rate once, that's called a bounce, lower it again, and after 2 successful lowering, that shows their resolve to do it, then the economy will kick off because we're making money easier to borrow. Back to our formula again. The money supply, the interest rate, business investment, and economic output. This changes this, changes this, changes this, and if we increase the money supply, then the interest rate is going to go down, and if the Fed says our target is to bring down the interest rate, the Fed funds rate, the discount rate, etc., and they're bringing down the interest rate in order to increase economic activity and business investment, which is going to increase the GDP. You don't want to be on the other side of that. If that's what the Fed says they're going to do, you better bet that way. It's awfully risky to bet against the direction that the Fed is signaling they're going to go. So the number one rule for investors is don't fight the Fed. because there's no amount of money that's going to limit them to accomplish what they want to do. So again, through this monetary policy, we can either expand the economy or we can contract the economy by increasing or decreasing the money supply and driving the interest rate up or down. And we're going to pick up with this idea of a monetary regime and the yield curve in our next session.